Blackstone is dumping houses on the US housing market, and they are taking massive losses on some of them. For instance, this is a house that Blackstone purchased for $490,000 in 2022. Well, they just sold it at a 27% loss for $360,000. Meanwhile, this is a property that Blackstone bought for $550,000 in 2022, and they cut the price all the way down to $415,000. And this Blackstone fire sale has the potential to lower home values in quite a few different cities and neighborhoods around America, because they are now liquidating one of their subsidiary entities called Home Partners of America. Home Partners of America owns more than 28,000 homes across the US, and they were bought by Blackstone Real Estate Income Trust in 2021. But now Blackstone is winding down Home Partners of America and liquidating many of the homes at deep discounts. And the fundamental issue is that these Wall Street landlords are now struggling to make money in the US housing market because it simply isn't profitable to own rentals anymore, with how much property insurance has gone up, how much property taxes have gone up, how high interest rates are today. It means that the expenses of owning real estate are now outweighing the revenue collected from rent, and thus many Wall Street landlords have stopped buying and some have started to sell. For instance, you can see this very clearly in a report from Redfin, which shows that investor purchases on the US housing market have plummeted by about 50% over the last 2 years to the lowest level since 2016 in nominal terms. Now, what I think is really interesting about this graph is that you see the last time investor purchases plummeted in America, that was the mid-2000s, right before the last housing crash. It seems as if investors have an intuitive sense of when to get out of the market. They see the downturn coming often before maybe the regular home buyer or before even some of the amateur investors. And as a result, you got to be paying close attention to what these big Wall Street landlords are doing, because it's not just Blackstone that's now starting to sell off their portfolio. According to data from Parcel Labs, we're seeing other landlords sell their portfolios as well. In particular, Amherst, back in late 2024, was liquidating properties in Dallas, Houston, Indianapolis, Jacksonville, and Tampa, while American Homes for Rent was liquidating properties in Dallas and Houston, and Progress Residential, they were also liquidating properties in Houston. And what this chart is measuring, everyone, is the percentage of these investor portfolios that were for sale towards the end of 2024. And so if an investor has 4% of their entire portfolio in Houston for sale at a given time, that's massive. That means that if they were to keep this sales pace over the course of a couple of years, they would completely liquidate their portfolio. And I know this sounds maybe confusing to some of you out there, because the conventional narrative and the conventional wisdom still is that Wall Street is buying all the homes. That's what a lot of people still say. That's what a lot of the news reports still say. But you have to understand that that is no longer happening in the US housing market. And in fact, it's now flipping into the opposite direction in certain cities, in certain neighborhoods, where these Wall Street owners are becoming net sellers. And the question is, do these Wall Street owners actually have the power to cause prices to crash in certain markets? Because I think we all know that during the upturn, the Wall Street investors definitely had the power to cause the prices to go up. But now that, for instance, Home Partners of America is in liquidation mode, are we going to see them drive down the values of real estate in the neighborhoods where they own property? Because I want to go back to this listing I showed you guys in the beginning. This is one of the biggest price cuts I have seen yet on the US housing market. You can see this is a house, a 4-bed, 3-bath in Wesley Chapel, Florida, which is about an hour north of Tampa. It's a really nice suburb, actually. Demographic data on ReventTrap shows that this zip code, where this house is, actually has a median income of $111,000. So this is one of the highest income zip codes in the Tampa metro, with 48% population growth over the last 5 years. And so in some ways, you would think this is the ideal area for an investor to own real estate, high income, growing population. Yet Blackstone bought this property for $490,000 at the peak of the bubble in 2022. They tried to rent it, right? They tried to rent it for $2,800 a month. They couldn't rent it. They cut the rent and then decided to sell. It was on the market for almost 8 or 9 months. I actually visited this property a couple months ago and showed it to you when its price was around $415,000, $405,000. Well, it ended up selling at $360,000. Price that's $162 a foot for a 4-bed, 3-bath house in in a nice neighborhood. The new buyer of this house actually got a really good deal. But the people who are not liking that comp are the other homeowners in that neighborhood. Because the other homeowners in that neighborhood, they all thought that their house was worth way more. 2 years ago when Blackstone bought it for $490, they looked at that comp and said, oh great, my house is now worth $490 or my house is worth $550. But now there's a massive wake-up call occurring. So I want you to look at this, everyone. This comp that just sold from Blackstone at $360,000 is by far the lowest sale in this neighborhood in the last 2 years. Like most of these other houses are selling for $540,000, $400,000, $394,000, $435,000, and these houses are smaller. The only house that's even close to this sales price is $372,000, a 3-bed, 2-bath, 1,400 square feet. This Blackstone house is a 4-bed, 3-bath, 2,200 square feet. So this is going to drag the value of these other houses down. In addition, folks, take a look at this. Clearly, we have a lot of builders nearby, a lot of builders on this development to the left, selling houses for $325,000 that are brand new. These new builds might have also had a downward impact on values in this neighborhood. But you know what's really interesting, everyone, is that when you actually look at the data on how much home values are dropping in Tampa and other parts of Florida and other parts of the Sun Belt, they're dropping, but they're only dropping by a couple percent year over year. In some ways, these anecdotal examples of houses selling at 25% discounts, they haven't yet made their way into the comps, into the year over year statistics. But I think 2025 might be the year when we start to see some of these massively discounted properties begin to start to drag down the overall value metrics. But what's really interesting, everyone, is that there seems to be a lag effect between seeing these massively discounted properties hit the market and be sold onto market, and then their impact on the actual sale price statistics year over year. Because when I look at the data on Reventure app, I'm not seeing a 20% drop in Wesley Chapel or other parts of Florida. I'm seeing a 2% year-over-year decline, a 4% year-over-year decline in some of these cities and neighborhoods. So I have to wonder, is 2025 going to be the year where we start to see these massively discounted sales from investors and from builders really start to drag down some of the average home price statistics and really start to be a wake-up call for some sellers on the U.S. housing market? Because the one thing that's still abundantly clear is that even though we're seeing all the signs of a downturn in the offing, especially in Florida and especially in the Sun Belt, we're still seeing many sellers ignoring this and still pricing their property high. For instance, Redfin just came out with a news report saying that the typical home is now taking nearly 2 months to sell. That's the slowest pace in 5 years. However, despite that, median asking prices from sellers are up 5.2% year over year. And you can see since the start of January, sellers are just getting really egregious in what they're asking for their homes, up to $407,000 for the median asking price, when last year it was around $385,000. And so that's really interesting, everyone, is that the days on the market is the longest it's been in 5 years. The inventory is the highest it's been in 5 years. The months of supply on the market is the highest it's been in 5+ years. And the demand is still tanking, yet sellers are still trying to ask for more and more for their home. And this is ultimately very frustrating part of the housing market right now, because it's almost like all the dominoes more or less have fallen in terms of saying that this is a downturn, things should get cheaper, yet the sellers are still trying to hold on. They're still trying to believe that somehow the market's just going to turn around. At first they told themselves, oh, the Fed was going to cut rates and then things were going to get better. Now they're telling themselves, Trump is president, and because Trump is president, things are going to get better. But at a certain point, everyone, the longer someone's house sits on the market, the longer that buyer demand just stays in the tank, the longer that investors stop buying and start selling, and the longer that builders keep flooding the market with inventory, the more that we'll eventually see downward pressure on prices, particularly in the Sun Belt, South, and regions like Florida and Texas. Because home prices are very overvalued, as much as 35% overvalued, according to some of these big Wall Street investors and home buyers. Let's take a look at this article from the Wall Street Journal titled, "Wall Street Thinks U.S. Homes Are Overpriced. Housing could be overvalued anywhere from 10 to 35% based on how investors are acting." And the basis of this is that the stock market is pricing portfolios of American homes at a hefty discount to what houses are changing hands for in the open market, with shares of single-family landlords, Invitation Homes, and American Homes for Rent trading at 35 to 20% discounts from their net asset values. Put another way, while the average house in the metro area areas where Invitation Homes owns its property sells for $415,000, the company's share price implies that investors think $310,000 is more appropriate. This is very interesting, everyone. Invitation Homes owns more than 80,000 homes. They're the largest publicly traded Wall Street landlord in America, and their stock price could be a good indication of where traders think the housing market might be heading. Let's take a look at this, everyone. Invitation Homes is now trading for $30.99 a share with a market cap of $19 billion. This stock price and market cap is down 6% in the last year, 12% in the last 6 months, and it's down about 19% since the Fed cut rates. And so this is strange. The Fed started cutting rates, but then the stock price of America's largest landlord dropped. The similar situation occurring for American Homes for Rent, who owns about 50,000 homes. Their stock price has dropped from $41 a share, $34 a share. Now that's a big deal, everyone, because in the last 5 months, the stock market more broadly has rallied. The stock market's gone up. There's all this euphoria in stocks right now, but that euphoria is not continuing for Wall Street landlords, and I wonder why. Well, for landlords, they can't make the math work. The average American home is valued at roughly a 4% cap rate, a measure of the annual net operating income a property could generate as a percentage of its market value. Meanwhile, large housing investors can borrow at 6.3%, meaning that these landlords would be losing money by buying real estate with debt, which is of course something I've been warning you all about for the last 2 years. I've been ringing the alarm bell on the investor bubble in the housing market going all the way back to early 2022, and my main argument the entire time was the math doesn't make sense for Wall Street landlords. And now we're seeing it happen in real time. We're seeing the Wall Street Journal report on it. We're seeing Blackstone liquidate one of their housing subsidiaries and sell houses at 27% losses. We're seeing the inventory in investor-driven housing markets explode, and we're seeing the prices start to drop. And so what I would encourage you guys to do is arm yourself with the data on what's happening in your market right now. Head to www.reventure.app and type in your city or zip code, where you can immediately start analyzing home value growth in the last year for free, as well as the trends in inventory in your market. Those two statistics are going to give you a solid foundation for understanding what's happening. But from there, you can access our home price forecast score, which is an indication of where we expect values to trend in the next year. This score is an index from 0 to 100. And if it's below 50, that indicates we think the market is going to trend down. If it's above 50, that means that we think the market is going to trend up. That price forecast is available under a premium plan at the cost of $39 a month or $399 a year under an annual plan. Sign up for that home price forecast right now so you can get the data in your city and zip code.